Welcome back to the FET Business Studies. I hope you will enjoy this lesson. Today we are going to look at the factors that should be considered when making an investment decision. Remember that when you invest, you expect to get the returns. The aim of investing, you invest with the aim of getting money back. These are the factors that should be considered when making the investment decisions. Number one, the return of investment. Two, the risk that is attached to the investment. Three, the investment term and the inflation rate. Coming to the return on investment, we are saying that this return on investment can be in the form of the interest, dividends, or capital growth. And there's a risk or there's a link between the risk and the return. The higher the risk, the higher the returns. And tax or taxation will always affect your returns. And when assets appreciate in value, this will have a positive impact on the capital gains. So these are the aspects that you need to consider under the return on investment. Coming to the risk can be low, it can be medium. For an example, shares, they might have low risk, they might have a medium risk. And the risk can be associated with the returns. The higher the risk, the higher the returns. Ordinary shares have the highest risk. Why? The investors, they might lose the whole money that is being invested when the company becomes bankrupt or when the company is liquidated. Whereas preference shares have low risk because during the payments of shares, the preference shares will be paid first before the ordinary shares. Hence, we say that the risk is very low under the preference shares. And you also need to check what other factors that the investors cannot control. The economic conditions, for an example, the COVID-19, investors don't have control. And we say that those factors, they can have higher risk on your investment. So you also need to check those things. Coming to the investment period, we say the duration of investment must be checked. And the longer the investment period, the higher the returns. Short-term investment will enable investors to access their money on a short period if needed, but they have negative impact. The returns will always be low for short-term investment, meaning that they yield low returns. And the other thing, you must understand the period. We have the medium, we have the long-term together with the short-term. So those are the periods. If you want to invest, you need to decide, are you investing in a short-term, medium, or long-term, depending on your needs. Inflation rate. The inflation rate, we are saying that it can decrease. Inflation rate decrease their purchasing power, meaning that inflation rate will affect your investment in a negative way. High inflation rate will always reduce your returns. And the return on investment should always be higher than the inflation rate. Remember, high inflation rate, it means that people will not have money to spend. People will not have money to buy goods and services. So if you have invested, or if you are running a business, you have invested on a business, this might affect your returns. Inflation has a positive effect on some of investments, such as property or shares, where the income will increase as inflation increase. Remember that when the inflation increases, what happened to the property? The value of the property does not depreciate. The value of the property keeps on appreciating. Hence, we say that this inflation might have a positive effect on some of the investments like the property.